If you woke up on Friday, December 12, 2025 and saw that the price of silver had fallen from a historic high of $64.66 per ounce to $61 to $62, if you felt the familiar fear in your stomach, listen carefully. What you see on the screens is not a market crash. This is the last desperate attempt of a system that is breaking down. On Thursday evening, the Commodity Futures Commission, CME Group, released an announcement that was supposed to change everything. They increased margin requirements for silver futures by 10%. Doesn't that sound very scary? Just another technical adjustment. But if you understand the architecture of financial markets, you know that this is a declaration of war. Most people believe that the price of silver is determined by supply and demand. This is completely wrong. The price of silver is determined by speculators trading futures contracts on the COMEX exchange. These contracts are so heavily credited that you can control millions of ounces of silver with just pennies on deposit. Before the margin increase, if you wanted to control 5,000 ounces of silver, you didn't need to have $320,000 in cash. You only needed about $12,000 to $18,000 in margin. This is approximately 25:1 leverage. Does this allow hedge funds to bet massive amounts with minimal capital? Yes. But it also means that the exchange has a death button, a button that can cause a market crash with a single click. The CME Group has issued a notice raising margin requirements. On contracts for 5,000 ounces of silver, the margin requirement increased from $20,000 to $22,000. Today, at 2 a.m., the exchange says, now we need $22 million. You have 1 hour to transfer $2 million, or we will automatically close your position. Where do you get $2 million at 2 a.m.? The exchange's computer automatically sells your contracts at the current market price. This creates a wave of artificial selling. It's not because the fund wanted to sell. This is because the casino owner has changed the rules of the game. This is called margin nuke, a nuclear strike on the margin. This is designed to flush out weak hands, speculators. When they sell in a panic, the price drops. And this is not the first time they have used this strategy. Banks are using the same strategy in 2025. They looked at the price of $64.66, they looked at the depleted storage facilities. They looked at a 5-year shortage of silver. And they increased the margins. In 2011, speculators were selling in a panic. This created a snowball of panic. In December 2025, something else did not happen. When the price dropped to $62, the price did not continue to fall. Instead, she resisted. At each decline, buyers appeared. The price bounced up. Why? Because the people who bought silver in 2025 are not speculators with 25:1 leverage. These are industrial users. These are sovereign wealth funds. These are companies that pay in cash. Tesla does not buy silver with leverage. Apple does not use margin to purchase solar energy. The Indian government does not borrow money for strategic silver reserves. India. That's where the demand revolution is happening. Indian economic growth is about 8.2% per year. The country of 1.4 billion people is moving from an agrarian economy to a high-tech one. In October 2024, India imported 60 million ounces of silver. This is 4 times more than in October 2023, when imports totaled 15 million ounces. India historically consumes 200 to 250 million ounces per year. Why? Because India is building 500 gigawatts of solar capacity by 2030. Every megawatt requires silver. And solar panels use 150 plus milligrams of silver per watt. By 2025, Indian silver ETFs are up 69% year-on-year, with monthly flows up 180% in August. But India is only half of it. China has already completed its transition to a high-tech economy. Now China is a global manufacturer of electronics, batteries, and semiconductors. In the first 9 months of 2025, China added 6.1 gigawatts of solar capacity, a 13% year-on-year increase. But this is only open access. Full production is much higher. When the price of silver rose, China did not panic. China began to accumulate. Because China sees silver as a critical mineral for the future economy. History repeats itself. In the 1990s, China was accumulating oil. China is hoarding silver today. When the West raises margins and tries to suppress the price, China quietly mines silver on the Shanghai Gold Exchange. China pays the market price. But China knows that this price is a gift, because physical silver works in the economy, and paper contracts will soon be useless. One argument: technology will allow you to use less silver. It is true that the industry is working to reduce content. First Solar develops technologies with copper contacts. These are real innovations. But there are two problems. The first is that the curve is slowing down. Improvements in reducing the silver content have slowed down. We have already applied the simplest optimizations. Second, new technologies require more. Topcon and HJT's advanced solar technologies use 150 to 200 milligrams of silver per watt, which is more than traditional panels. Because these technologies achieve higher efficiency with a larger contact area. Even if we develop technologies that use less silver per watt, the overall consumption is increasing because we are installing more and more panels. Simple math. JP Morgan has held a short position in silver for years. This means that they had a financial interest in keeping the price low. If the price drops, they earn. If it grows, they lose. The bank was accused of manipulating prices through spoofing, placing large orders without the intention to fulfill them. JP Morgan paid $920 million for this in 2020. Deutsche Bank was fined $130 million for this. Paul Kaplan bought 30 silver contracts in May 2008 for $1,875 and sold them for $952, a loss of over $1.3 million. Scale this up, and retail traders' losses run into the billions. On Binance in December 2025, it was revealed that employees manipulated token prices through social media. The prices of some tokens have increased by 150%. Binance has already been fined $4.3 billion for using bots. What does this have to do with silver? All. This shows that manipulation is embedded in all markets controlled by financial institutions. Whether it's COMEX or Binance, the structure is the same. The institution controls the market through technical means. Receives financial benefits from suppression or hype. Uses power to manipulate the price. When people understand manipulation, the system collapses. Silver is in the fourth phase. Global silver production in 2025 is approximately 835 million ounces. This is 7.23% lower than in 2016. When production is reduced and demand is rising, you get a shortage. The 2025 deficit is projected at 125 million ounces. The vaults in London tell the story of the collapse. At the end of November 2025, there were 187 tons in London's storage facilities, estimated at $47.1 billion. The demand for supplies is growing. In the first week of December, over 47.6 million ounces were claimed for delivery from COMEX during 4 trading days. This is 60% of the monthly average stock. People are making demands for delivery. They don't want futures contracts. They want physical silver. Something extraordinary happened between June and October 2025. JP Morgan sold its entire 200 million ounce short position. They raised the white flag of surrender. They decided that it was no longer profitable to hold the price will fall position. Instead, they started building a long position. They started buying physical silver. It is estimated that their physical silver is about 750 million ounces. This means that the largest manipulator of the silver market has given up. They looked at the numbers and realized that they were on the wrong side of history. Sprott Asset Management forecasts a 125 million ounce silver shortage for the 5th year in a row. Hamada Mark expects $71 to $73 in 2026. Bank of America expects $65 per Oz by 2026. Samsung is one of the largest manufacturers of solar panels. When the price increased by 108%, Samsung was forced to change the supply chain, invest in recycling scrap silver, and revise designs. Intel is facing a problem. Silver is used in solder for electronics. When prices rose, Intel was forced to reassess production models. General Electric, which manufactures turbines, uses silver in the electrode. With the rising cost, GE raised the prices of the products. This is a margin compression stream. Manufacturers must either raise prices or absorb losses. Both results lead to higher prices. We're running out of silver. Silver extracted from new mines is decreasing. The mines are getting old. It takes more energy to mine less silver. The demand doesn't go away. We cannot build a future without silver. There is no way. The world is switching to solar energy and wind. It requires billions of panels. Each requires silver. There is no substitute. You can't use copper instead of silver in a high-performance panel. Silver is necessary for the life of the future. Saturday, December 13, 2025. We survived the nuke margin. The global system tried to turn on the death button, and it didn't work. If you're holding physical silver, go easy. You own an asset that the world needs and cannot print. 1 ounce is always 1 ounce. And it becomes more valuable every day. The game has changed. The old rules are gone. New rules are a physical rarity. Whoever holds the metal makes the rules. Subscribe. And remember, in the war for resources, the physical wins over the paper.